Now, according to this article, it says signs that a stock might be a dividend yield trap. Some things to look out for are unusually high yield, excessive debt, dividends greater than earnings, little or negative cash flow, and or problems with business. But what if I told you that from day one, a lot of us were actually lied to when it comes to investing into higher yielding assets, because most investors out there think that anything yielding north of 5, 6, 7% is automatically a yield trap. Well, in this video, we're going to dig a little bit deeper into what a dividend yield trap actually is and go over some stocks and ETFs that actually might be and or are yield traps. But then later on in the video, I'm going to share with you some ultra high yielding stocks or ETFs that also might be labeled as yield traps, but are definitely far from it. So if you're a dividend investor that has an interest in higher yielding stocks or ETFs, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, before we go over some actual examples of stocks and ETFs that are yield traps and some that get labeled as yield traps but aren't, I'm going over in detail so we're all on the same page of what to look out for when it comes to dividend yield traps. So first off, it says unusually high yield. The most obvious sign that you might be looking at a dividend yield trap is a dividend yield that seems unusually high. To be clear, this isn't a 100% effective way to detect a yield trap though, as many stocks pay high yields for completely legitimate and sustainable reasons. For example, some companies such as REITs or MLPs are required to distribute a certain percentage of their income. Also, excessive debt we talked about. The more debt a company has, the higher the likelihood that it will need to cut its dividend during a tough economy. One effective way to evaluate a company's debt load is to look at things like the debt to equity ratio, which you can calculate quickly with information found on a balance sheet. For the most valid comparison, look at the debt to equity ratios of companies in the similar industries. So these are pretty good so far. Let's keep reading on. It says dividends greater than earnings. One useful metric for dividend investors to know is the payout ratio, which is calculated from the company's annual dividend payout rate divided by its earnings. A high payout ratio, especially over 100%, may indicate that the dividend is not sustainable, as this means the company isn't earning enough profits to pay its dividend, and may be financing through debt or other means. And then they also have notes REITs might have different ways of calculating this. That's a really useful tip right here. Looking at a stock's payout ratio is probably one of the fastest, easy ways to get an idea of if or if not the dividend could be sustainable. Next, it says little or negative cash flow. Sometimes earnings can be deceiving due to things like one-time accounting items. So another way to assess whether a dividend is too high is to compare the company's cash flow. Simply put, a cash flow is the difference between the company's money coming into the business and the money going out of the business. All public companies issue a cash flow statement. So this information is rather easy to find and in many cases can be more useful than evaluating earnings. Now, lastly, it says problems with businesses is also a very important one and sort of more of a fundamental way to look at the business. It said finally, another reason a high dividend stock can be a yield trap is if there's something wrong with the business itself. One thing to check is the stock's price performance over the last year or two. If the high dividend yield is due to the rapid decline of a stock price, it's a good idea to look into what's happening, why is the stock dropping so much, etc. So even though those are all very legitimate things to look through, when it comes to trying to figure out if or if not a stock or ETF could be a yield trap, I think that the idea that generally any stock or ETF that's yielding above, say, 4, 5, 6% is a yield trap is honestly far from the case. Now, going through a few stocks that might or might not be yield traps. For example, we have Verizon stock. Verizon stock is currently offering around 6 or 7 or even as of recently 8% forward dividend yield, which is massive compared to most other stocks and ETFs across the market. But because of things like Verizon's debt load and just the industry the business is in that seems to be declining rapidly, on the max time frame, Verizon's share price, even with the massive yield, is down around 22.78%. So investors that got sucked into buying shares of Verizon that were hoping to earn a healthy 6 or 7% per year, even back in the day, have basically held on to a stock that's been dropping in share price consistently over the past several years. Now, another example of this is AT&T stock, a stock that I bought early on in my dividend investing career because I wanted a piece of that 5, 6, 7, 8, 9% yield, whatever it was back in the day. But over the past 5 years, not only has AT&T basically lost a quarter of its value as far as the share price goes, but on top of that, AT&T, because the dividend was not sustainable, actually did a massive dividend cut, and this was back in 2022. Now, another example of a potential yield trap could be something like QYLD or the Global X NASDAQ 100 covered call ETF. This ETF offers around 12% forward yield and has been paying massive distributions to investors for several years now. But even with all those massive monthly distributions investors have received, if you were to have bought QLD, and this is back during inception, you would be down around 32-33% as far as price return goes, which isn't horrible considering you're earning around 10 to 12% per year in yield, but still holding on to an ETF that's continuously lost value is nothing we want to do. But here's a few examples of different ETFs and stocks that offer a well above average starting yield, but are not only not yield traps, but are far from it. Something like JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This ETF offers around a 9 or 10% trailing 12-month dividend yield, but on top of that, JEPQ over the last year is up around 6.7%. On the max time frame, JEPQ is only up around 4%, but with paying investors around 10%, 9% per year, this ETF, even though it offers a massive starting yield, and because of this, some investors out there or some analysts would call this a yield trap, JEPQ is far from it. Another one of my favorite examples of a single stock that maybe, especially back in the day, was labeled as a dividend yield trap is Main Street Capital, which currently offers around an 8.5% forward yield and has been paying dividends and more dividends over time. Now, anytime you see a stock that's offering north of a 6, 7, 8, 9% yield, you normally think it's going to be a yield trap and that the stock is going to trade down and to the right. But Main Street Capital is a perfect example. That's a massive high starting yielder, but also has went up around 280%, and this is over the last 17 or so years. Another great example of a super high yielder that also is not a yield trap, but a lot of people used to call this one also, is Enterprise Product Partners, or EPD, which currently has around a 7 or 8% forward starting dividend yield and has been paying more dividends over time. Even though EPD has a massive starting yield, this stock is up around 438%, and this is since around 1998. So I mostly wanted to make this video just to remind especially all the newer investors out there that just because a stock or ETF offers north of a 4, 5, 6, 7% starting yield, it does not necessarily mean it's a yield trap. It more or less is going to have a lot more to do with the underlying situation of every single stock or ETF that you're looking into. And honestly, the short list that we talked about during the beginning of this video, I think those are some perfectly reasonable things to look through when you are, of course, evaluating a stock or ETF and figuring out if or if not the starting yield, because it's high, could be unsustainable. But I really just wanted to make a video and sort of remind everyone out there that just because a stock or ETF offers a high yield, it does not mean that not only it's a bad investment, but also on top of that, a higher yielding option could even outperform some lower yields out there, depending of course on what you're looking at. Now, to sum this video up, I just wanted to make it a very clear point and recognize that not every high-yielding, dividend-paying stock or ETF is necessarily a yield trap. Some companies maintain high yields due to things like stable cash flow, strong balance sheets, and prudent management. But again, some companies and ETFs are offering yields that are rather high because the companies could be in trouble. More or less, it's key to be able to distinguish between a high-yield trap and a genuinely attractive high-yielding investment, like some of the different investment options we talked about in this video. And I think it's important to remember that for the most part, at least, higher yielding dividend paying stocks and ETFs a lot of times are a little bit more risky, but not necessarily every single one out there. You have to look into the underlying strategy. You have to look into the underlying company. There's a lot more at play here. So now that we talked about dividend yield traps and why or why not some stocks might actually be them or not, I want to lastly hear from you guys down below. What is one stock that you accidentally got sucked into buying that turned out to be a dividend yield trap? I'll name a few: AT&T, Verizon stock, MPW, the list goes on and on. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.